Hello viewers, so welcome to my channel. I'm Hasham. Last video I have explained you about the income from house property. When an income will be treated as income from house property. So when a person has given the property on rent, rent is received. The owner of the property who has given the property on rent, rent is received, that will be taxable under the head income from house property. So I have explained you in detail regarding different uses of the property. First of all, an assessee can use the house property for his own residential purpose, or a person can use the residential property for running his own business or profession, or a person can let out the property. There were three uses are there. If he let out the property, he will get the rent, and that is taxable under that income from house property. If he uses the property for his or her own residential purpose, the annual value will be nil. Only few deductions are allowed. Whereas if a property is used for running his own business or profession, then the income from that property will be taken as nil, and no deduction will be given. Expenditure, the property expenditure will be dealt as business expenditure. All these rules. And let out property are also two types. The property which is the rent, which is covered under the Rent Control Act, the property which is covered under the Rent Control Act, and the property which is not covered under the Rent Control Act. These two category of houses. So methods of calculating, how to calculate, that means basis of charge, annual charge for annual value. For calculating annual value, four factors should be considered. That is municipal rental value, actual rental value, fair rental value, and standard rental value. So how to find out the income from house property? First of all, we calculate the expected rental value, ERV. Then we calculate GAV, gross annual value. From gross annual value, deduct the municipal taxes or local taxes. We'll get net annual value. From net annual value, give the deductions under section 24. Then we'll get the income from house property. These are the points I have explained in detail in the last video, and this video is the continuation of the previous one. So before starting this video, take a screenshot of the points which I have written. Then I'll explain all the points. Come on, first of all, what is the format of finding out the income from house property? In the last video, previous videos, while computing income from salary, I have shown the format, how to find out the income from salary. Similarly, the format of computing the income from house property will be like this. So first of all, two columns I have opened. Gross annual value. In working note, we have to find out GAV. The gross annual value depends on whether the house is governed by Rent Control Act or not governed by Rent Control Act. Different steps are there. So while doing the problem, I'll explain you how to calculate the GAV, gross annual value. After finding out gross annual value minus municipal taxes, this will be given in the problem, or sometimes it is called local taxes. Deduct, will get net annual value, NAV. From NAV, deduct the deductions under section 24. Only two deductions are there. You have to remember only two deductions, not the third one. So the two deductions are, first one, standard deduction under section 24A. Secondly, interest on loan under section 24B. So 24A and 24B, these are the only two deductions under section 24. Then we'll get the income from house property. That's it. So simple. This is the format. Now, deductions under section 24. Two deductions are the standard deduction and interest on loan. I'll elaborate. So this is a compulsory deduction. This standard deduction under section 24A is a compulsory deduction. Any person who is having income from house property which is let out will get standard deduction. So having let out, the deductions is given at the flat rate of 30% of NAV. This is the provision given by IT Act. It will not be specified in the problem. You have to remember, every problem, when the house given is let out house, then you have to give this compulsory deduction. Whatever NAV you get, 30% of this NAV will be allowed as standard deduction. Next comes interest on loan. This second deduction. If an owner of the house has taken a loan for the purpose of purchasing, construction, repairing, renovation and reconstruction of the house, then interest paid on that loan will be allowed as deduction. Not every loan. While the loan is taken for 5 purposes. The loan is taken for the purpose of purchasing the house or constructing the house or repairing the house, renovating the house or reconstructing the house. For this 5 purpose only, if the loan is taken and interest is paid during the previous year, then only deduction will be allowed, this interest bill. If in the problem, interest on loan is not given, so he will not get the interest on loan, it's not compulsory. The second deduction is not compulsory. If there is interest on loan, then only we'll get the deduction. Secondly, if the interest is paid within India, if the loan is taken within India and interest is paid within India, then only it will be allowed as deduction. If the interest is paid outside India, that means the owner of the property has taken a loan outside India. Income Tax Act says interest paid will be allowed only if TDS is made from that interest. Suppose if I have taken a loan of 10 lakh rupees from my friend who stays at London. So every year I am paying 10% interest. So 10% of 10 lakh, 1 lakh rupees I have to pay the interest. Income Tax Act says before paying the interest, deduct the TDS. Suppose the TDS is 20%. So my responsibility is out of 1 lakh rupees, deduct 20,000 TDS, paid this TDS to the income tax department, and 80,000 only you have to pay to outside India. If you do not deduct TDS entirely, if you pay 1 lakh rupees, nothing will be allowed as deduction. That is the rule if interest is paid outside India. Next, interest on loan is allowed on due basis also. Not necessarily to be paid compulsorily. Even if it is due, not paid, it will be allowed as deduction. For example, I have taken a loan from bank for rupees 10 lakh. Interest is to be paid 20%. So 20% of 1 lakh 20,000 rupees I have to pay. But during the year I have paid only 10,000 rupees. Only 10,000 I have paid. Income Tax Act says complete 20,000 it is allowed, whether you pay it or not. So even if it is due, it will be allowed as deduction. Then interest on loan taken to purchase or acquire the property or to construct, the interest paid for a period prior to construct the house will be allowed in 5 annual equal installments commencing from the previous year in which the house is completed. Now see here, sometimes a person has taken a loan and interest is paid prior to the construction of the house. So interest paid prior to the construction of the house, that interest will be allowed as deduction in 5 annual equal installments commencing from the date of completion of the construction. Example, if a person has taken a loan in the year 2015, but after taking the loan in 2015, he started constructing the house. The construction of the house has taken 3 years, 16, 17, 18. And during the year 18, the house was completed. So whatever interest paid by the owner from 16, 17, 18, these are the interest paid prior to the construction of the house. And this interest will be allowed as deduction in 5 annual equal installments commencing from the date of completion of construction. Right now, simply you remember this point. While doing the problem, we'll come across this point. I'll explain again. Next, interest relating to the year of completion of construction can be fully claimed as deduction in the year irrespective of the date of construction. Current year, the construction was completed in the middle of the year. Middle of the year, the construction is completed. Then interest will be allowed for the whole year. We should not calculate the interest only for the period of construction during the current year. The whole year interest will be allowed as deduction in the year of completion of construction. Next one is interest on interest is a penal interest that will not be allowed as deduction. Sometimes what will happen, interest is due. On that interest, again interest will be calculated. That is called penal interest. So if in the problem given penal interest paid, not allowed as deduction. The next one is brokerage or commission paid or expense incurred to raise the loan. Sometimes in order to take a loan from bank or loan from any other source, some commission agents, some brokers are there. So brokerage has to be paid, commission to be paid to raise the loan. That brokerage or commission will not be allowed as a deduction. So these are the points you have to remember while doing the problem. Will come across this point. So you should be in a position to decide whether it is allowed or not. Next, very important note. From the assessment year 2002-2003, the format of computing income from house property has changed. Before 2002-2003, a number of deductions will be allowed in computing income from house property, like collection charges, repairs, ground rent, land revenue, brokerage paid, so many deductions. That means whatever expenditure incurred in earning the income from house property, that expenditure will be allowed for deduction. That rule was there before 2002-2003. From the assessment year 2002-2003, Income Tax Act has changed the format. Now Income Tax Act says no deduction will be allowed for repairs, for collection charges, for land revenue, for ground rent, for brokerage paid. All these deductions are not allowed. Now presently only two deductions are allowed. That is standard deduction and interest on loan. No third deduction. While doing the problem, we'll come across these points: repairs, collection charges, ground rent, land revenue, insurance premium, etc. All these items will be given in the problem. Your job is, in note, you should specify thus these expenditure will not be allowed as deduction. That's it. This special note you remember. Composite rent. If the owner of the building charges for facilities provided to the tenant or higher charges for using other assets, then the rent received is known as composite rent. Sometimes the owner of the building is providing some facilities like lift maintenance, security, water supply. These are the facilities which are provided by the owner of the building to the tenants. And in that case, the owner is charging some extra amount, not only the rent of the building, but also the cost of the services provided. The lift facility provided, the security guard services provided, water provided. So these are the facilities which are provided. So apart from rent of the property, the cost of the facilities will also be charged. If cost of the facility is also charged, then it will be called a composite rent, combined rent, rent of the building and cost of the facilities provided. Now the example of facilities of the tenant are providing lift, gas, security, water, electricity, etc. These are the examples of facilities which are given by the owner to the tenant. Now, where the composite rent includes the rent of building and rent of using other assets is separable, then rent of building, income from house property, rent of other assets, income from other sources. Income Tax Act says when composite rent is charged from the tenant and the composite rent is separable, is capable of separation, how much is the rent of property and how much is the cost of the facilities. For example, I am the owner, I am charging 40,000 rupees from my tenant. Out of 40,000, I'm saying to the tenant that 30,000 is relating to the building and 10,000 is the cost of other facilities provided. It is easily separable. Income tax axis. 30,000 will be chargeable to tax under income from house property, and 10,000 rupees which are separately chargeable for other facilities will be chargeable to tax under income from other sources. If it is separable, suppose if the composite rent is not separable, the entire amount of rent received will be taken under income from other sources. If a situation is like this where the cost of facilities cannot be separated from the rent of the building, that means rent of the building and cost of the services provided are one and the same. We cannot be able to separate it. Composite rent is not separable. In that case, Income Tax Act says the entire amount of composite rent is taxable under income from other sources, not under income from house property. That is the rule. Now, let out houses. Broadly, we have two types of houses, that is let out houses and self-occupied house. What are the provision for let out house? Remember, whatever explanation I am giving, if you listen carefully with full concentration, then you don't find any difficulty in solving the problem. The problems are based on this discussion in this lecture which I am giving. If you do not listen this lecture, then definitely every problem will be difficult. The problems are based on the provisions, what I am explaining here. So give more concentration, don't skip the video, watch the video till the end. So two types of houses, let out houses, self-occupied. So what are the rules for let out houses? You have to remember here, very important rules. There are seven types of let out houses. For our understanding, we have classified the houses into 7 types. For our understanding, it is not specified according to Income Tax Act. So what are the 7 types of let out houses? First, when the house is let out throughout the previous year, and there is no unrealized rent and vacancy allowance. First of all, unrealized rent. The rent which is not received from the tenant. Example, my tenant has occupied the house for the full year, but during the 12-month period, he has paid the rent only for 10 months. For 10 months, he has paid the rent. 2 months rent is unrealized, not realized. That is called unrealized. Vacancy period. It is not necessary that the whole 12 months it is let out. During the 12-month period, suppose the old tenant has left the house, has vacated the house, and after vacating the house remained vacant for 1 month. There was no tenant at all. So this 1 month period in which there is no tenant is called vacancy period. So sometimes an owner may have unrealized rent, the owner may have vacancy period. The first case is when the house is let out throughout the previous year and there is no unrealized rent, there is no vacancy period. First case. Second case, let out house, unrealized rent of current year, and the house was not vacant during the previous year. During the whole year, there is unrealized rent, but vacancy period is not there. That means 12 months it is completely occupied, but there is unrealized rent. Second case. Third case, let out house is vacant for some period. There is no unrealized rent. During the whole year, there is vacancy period, but there is no unrealized rent. This is the third case. Fourth case, let out house. In let out house is vacant for some period and unrealized rent is also there. During the previous year, the house is vacant for some period, 1 or 2 months, and also there is unrealized rent. Both vacancy period is there and unrealized rent is also there during the previous year. These 4 cases. Fifth case, the house was vacant for 12 months during the previous year. That means the SSC's house property, the owner's house property was vacant throughout the 12 months previous year. No occupant. How to calculate income from house property? It is not necessary that only if rent is received, then only income from house property. No. Income Tax Act has given the provision, even if the house is vacant for 12 months, no benefit is derived, but still we have to calculate income from house property on the basis of notional rent. That will do it while doing the problem. This is the fifth case. Sixth, if the house is situated in metro cities. In India, the metro cities are Mumbai, Delhi, Kolkata, Chennai. So what is the rule? How to compute the income from house property in metropolitan cities? Then house property is situated in foreign country. Sometimes an SSC is having a house property in a foreign country, but his residential status is ordinarily resident in India. In the previous videos, I have explained you, if the position of the SSC is ordinarily resident in India, then global income he has to pay the tax. Not only on Indian income, but also on foreign income he has to pay the tax in India because he is ordinarily resident. So how to compute the income from house property if the house property is situated in foreign country? So these are the 7 possible cases when the house is let out. So one by one case we have to finish off. So if you concentrate this theory, definitely it will be very much advantageous, not only in doing the problem, but in examination. Theory question will be asked regarding what is composite rent, what are the rules regarding interest on loan, what is standard rent, what is the format of computing the income from house property. So these are the things which are necessary even to attempt a theory question as well. Now, first case. First case is when the house is let out throughout the previous year and there is no vacancy period, there is no unrealized rent. No unrealized rent, no vacancy period. So what are the steps? How to calculate the GAV? Very important first step is calculating the GAV, gross annual value. Once we get to the gross annual value, easily we can follow the remaining procedure. The remaining steps are very easy. The only difficult part is how to compute the gross annual value, GAV. That point only I am going to stress now. Now, if the house is let out throughout the previous year, no vacancy period, no unrealized rent, then step 1, calculate ERV. Remember carefully, calculate ERV. ERV stands for expected rental value. So the ERV is higher of the following 2 amounts. Only 2 amounts you have to compare. That is MRV and FRV. MRV, FRV. Municipal rental value, fair rental value. The higher of these 2 amounts is called expected rental value. Then calculating adjusted ERV. Second step. This calculating adjusted ERV is required only if the house is governed by Rent Control Act. If the house is not governed by Rent Control Act, this step, adjusted ERV, is not required. How we can be able to know whether the house is governed by Rent Control Act or not? In some problem it will be given. The house is governed by Rent Control Act. In other problem it will not be given, but standard rent is given in the problem. When standard rent is given in the problem, it is understood the property is governed under Rent Control Act. Then adjusted ERV. List of the following 2. List of the following 2. First one, ERV. Expected rental value, first step we have calculated. Second one, standard rental value. Standard rental value is the rental value which is fixed by the Rent Control Act. Already I have explained in the last video. The lower, first step, ERV, which is higher of the following 2, MRV, FRV. Second step is applied only if the house is governed by Rent Control Act. List of the following 2, ERV, SRV, expected rental value, standard. Then third step, calculating the ARV, actual rental value. What is the rent received or receivable? ARV is equal to rent received plus rent receivable plus or minus special adjustment. What was special adjustment? While doing the problem, I will discuss. This is the third step. Now, fourth step, calculate the GAV, gross annual value, which is higher of the following 2. Higher of the following 2. ERV, if SRV is not given, or adjusted ERV is if SRV is given. If the house is not governed by Rent Control Act, simply you take ERV and ARV, whichever is higher. A ERV, B ARV. ERV or ARV, whichever is higher, is the GAV. If the house is not governed by Rent Control Act. If the house is governed by Rent Control Act, then adjusted ERV or ARV. Adjused ERV or ARV, whichever is higher, is the GAV, gross annual value. That's it. Once we get the gross annual value, deduct municipal taxes is equal to NAV. From NAV, give the deductions under section 24, we will get income from household. The first case I have completed. Inshallah, in the next video, I'll continue the last video for theory explanation, then we'll start the problem.